So if you Google top searched retirement topics right now, one of the things that is probably going to pop up at the top, so we know a lot of people are concerned, is how will my taxes change after I retire? Great question. We have the answers for you. Give me just a minute. I love this question. How will my taxes change when I retire? I love it because I work with this scenario every single day when we sit down with people that are making that transition into retirement. It's part of the financial planning process. We love running the numbers. We do the math so our clients don't have to do the math. But right now, we're just going to walk you through it. There's certain questions that you should be asking. Yes, there are things that you should be concerned about. But at the end of the day, as long as you have a plan, you'll be more successful. So let's take a look at what's the difference between taxes in retirement versus taxes when you're working. It's all still going to boil down to what is your income in retirement versus your income while you're working. So I think for most of us, we're not looking to have a decrease in our lifestyle when we make that transition to retirement. So the question becomes, what is your retirement going to cost you, or what are your expenses? So when I'm working, I've got an employer or I run my own business, or wherever my income comes from, I certainly want that number to be as high as it can possibly be, regardless of my tax rate, whether it's, I have state taxes or I don't have state taxes or whatever the federal number is. I'm still trying to get that number as high as I possibly can because I'm going to spend what I need to spend to cover my expenses to maintain my lifestyle. And then I'm going to save whatever's left. And as I'm working, I'm using things like 401ks and IRAs or other retirement accounts, maybe Roth accounts, to set money aside for retirement. But specifically things like 401ks, when I make that contribution to a 401k, that money comes right off the top line of my income that I'm getting that year. And I'm not going to pay tax on that while I'm working. I'm going to pay tax on it later when I take distributions from that 401k later in life. So your taxes while you're working is very specific to employment income, is usually going to come back to you depending on who you work for, but in the form of a W-2. So you're probably familiar, you've seen that. Usually with the W-2, the taxes have already been paid because you told your employer to withhold taxes from your paycheck. So at the end of the year, when you do your taxes, the taxes have been paid. We don't like surprises. You know what we like? We like a check back from the IRS instead of having to pay more. So that's usually how that works. But maybe you have some investment income that's going to go into it. Maybe you have income from other sources, real estate, farm income. And when we see this, depending on who you are and what your investments are. But then you make this transition into retirement. So suddenly that W-2 from work is going to end, that income from work is going to end. And this sort of automated process of this automatic withholding from your income from employment is going to end as well. So one of the first things that we need to do is not only identify what our taxes are going to be, because it can likely change, but then also identify how are we going to continue to pay those taxes and how could we withhold that from the income that we have. So income while we're working might be in excess of what we actually need to maintain our standard of living. And like I said, the excess money typically goes into investments, maybe retirement plans or something else. But now that we've retired, we're going to take a closer look at what our actual expenses are. We want to make sure that we're covering those expenses, and we want to make sure that we're taking just enough income to cover all of our expenses so that we pay taxes on what we need, not excess of what we need. We want to defer that longer. So what you would do is you would sit down, figure out what's your budget to cover everything. I'm not talking just electrical or insurance or, again, other utilities or car payments or house payments. I'm talking everything, food, going out, having fun. What's your total budget? So pick a number. It's different for everybody, but let's just say it's $10,000 a month. That's a nice round number. So if your expenses are $10,000 a month, your expenses are $120,000 a year. But we can't look at it as if, well, if I just had $120,000 in income, that's going to cover it, because it doesn't, because you need income net of the tax you have to pay. So the reality is, to get to $10,000 a month and spend it, you have to pull more out of maybe investments, or you have to have more income from other sources, and we have to take a look at all of that. But the reality is, let's figure out what you need and not take more out of retirement accounts or other sources of income than you need, because if you are, you're paying more tax than you need to. And the ability to continue to defer that is going to help you keep your tax bracket lower. So many times, not all of the time, but many times in retirement, if we take a very close look at it, we can do a good job when it comes to income planning and tax planning to help you bring your tax bracket lower. So many people are in a lower tax bracket in retirement than they were when they were working, even though they're maintaining their lifestyle. And you notice I keep saying lifestyle because that's very important. And then if we want to get more efficient over time, we want to start taking a look at the future. So obviously we're going to take a look at your tax situation right now, but a good investment advisor, a good fiduciary is not just going to look at today. They're going to take this out 5 years, 10 years, 20 years, 30 years, whatever that expectancy is, because we're never going to know what tax rates are going to be 5 years from now or 10 years from now or 20 years from now. But at least now we can take a look at current tax rates. We can be realistic. We can say, all right, current tax rates are low, actually very low historically. So if you're going to have a good tax plan in retirement and you want to see how you're affected long term, you probably want to take a look at things like Roth conversions. So I know a lot of you probably know what a Roth conversion is, but this is a way to convert those 401k assets, those traditional IRA assets, 403b, maybe even TSP, just depending on who your employer is. But these are assets you haven't paid taxes on yet. You will be forced to pay taxes on it when you get to, today it's 73, they're moving it to 75, but you will reach an age in retirement where you're forced to take distributions from accounts you haven't pulled money out of yet. And that is going to be taxed as ordinary income. So the rates today are historically low. The rates in the future could be significantly higher. Obviously, we're all worried about the national debt. How would the government get money to pay down the national debt? In theory, and most likely taxation. Are they likely to raise taxes in the future? Could very well happen. So are you working with an advisor that's going to show you the benefits of not only of Roth conversion, meaning moving money from 401ks, paying the tax now, not having to pay tax on it again, but the mechanics of those Roth conversions. You can't just say, well, I want to convert my entire retirement account from taxable to non-taxable in the future without a plan. Because if you did that ultimately and you did it all at one time, you'd wind up putting yourself in a much higher tax bracket, paying more tax than you need to, when you could actually have a plan in place to convert those dollars to tax-free dollars over time and in the future. So yes, things are similar but different when it comes to taxes while you're working versus taxes when you're retired. It is very possible that you can reduce taxes while you're retired, get yourself in a lower tax bracket, but you have to have a plan in place to take advantage of programs that are available to you. Again, things like Roth conversion, but then also understanding where should you pull your money from. You've got income from Social Security if you're pulling it. Well, that's a fixed income. Maybe you have pension income. That's a fixed income. But after that income, you have options on where should I pull money from? Should I pull it from my 401k account? Should I pull it from my IRA account? Should I pull it from an individual or a joint account? Should I pull it from a Roth account? Or should it be a combination of all of it? So it's not as simple in this example as I have $10,000 a month in expenses. Where does that money come from? How is it taxed? And ultimately, how can you be as tax efficient as possible moving forward in retirement? And it boils down to, let's pay our fair share of taxes, but let's not pay more than we have to. Thank you for watching. Go to guardingyournestegg.com for your free and objective personal financial plan.